Okay, hello everybody. This is the second part of the discussion of the Chapter 6 module dealing with revenue recognition. And once again, I apologize for some of the issues we're having in terms of real-time delivery and whatnot. We're changing rooms, and you probably by now have already seen the email I've sent to everyone. For whatever reason, it's just not happening for us here in room 212 in Smith Brasher. So we're going to move, and I've never had these kind of issues before, but it's going to be better if we move, and that way we are in a better place, I think, in order to avoid some of the issues. I think this is very old equipment in this room, is what I think is happening, but I'm not a tech person. I don't know, but anyway, it's just not a very good look for us to keep delaying these. And I really wanted to make sure that we are keeping pace with what we're supposed to be doing here. And we're in Chapter 6 right now. One of the things I mentioned in my earlier video is I've deferred the due dates for Chapter 6's material, which is what I was going to do anyway, just because the syllabus itself is sort of prefabricated, really, and I don't always adhere to the due dates. We do have to cover all the material that's called for, just simply because Intermediate 1 is a prerequisite for Intermediate 2, and for those of you who are going to go on to take the capstone, all this material is important. So I really think it's important that we do cover it all, but and which is why I'll do supplementary videos if we don't have time in order to cover all this material. So the SmartBook quiz is going to be a week from it's going to be on Friday the 17th, and then homework and a bonus if you want to do it also on the 19th. And so hopefully my goal is by Tuesday of week 7, I will have gotten through most of Chapter 6. It is a fairly long chapter. It's fairly dense. And as I mentioned earlier, personally, I think it's one of the more critical chapters in intermediate accounting, certainly in Intermediate 1, in the sense that revenue recognition is really an important topic. And by the way, it sort of varies, or it sort of diverges from some of the material that we've had in the foregoing chapters, which much of it, frankly, is a bit of a review from what was covered in introductory principles courses. Here we dive a little bit deeper into revenue recognition and talk a lot about what are the various types of transactions that might involve differential means of recording revenue, and it's the when and the how much. And I know that the how much seems like it's the important topic, but oftentimes it's the when, as I mentioned earlier, is just as important, and maybe more, and maybe trickier, frankly, in terms of recording revenue. And then also, we'll get to in this particular video today, we'll talk a bit about the fact that sometimes we don't always know what the amount of revenue is. So the dollar figure is sometimes difficult, and it is subject to a bit of estimation. So these are the due dates for Chapter 6. By the end of week 7, we'll get into talking about cash and receivables, that is, those current assets, which we'll talk about. And I've deferred the due dates on those as well. As I did leading up to the first exam, my long-running objective is to give people more time to do work as opposed to less. And so I've deferred those due dates a week as well. I think I may have adjusted these already in Connect and also in Brightspace. That is the Chapter 7, just in case you want to work ahead. The chapter coming after that, Chapter 8, I don't believe I've adjusted those due dates, but if you want to work ahead, feel free to, because you're obviously able to do it, but the actual due dates themselves are going to be pushed back. I know because of the fact that we have very few students who attend anywhere, I mean, physically attend, a lot of people are sort of viewing this as sort of an independent study kind of course. It's not what it's designed to be, but it's what you want it to be, and that's what Attend Anywhere. The logic of it is to allow students the 3 different options of attending, and whatever works best for you is fine with us. You know, as long as you're satisfied with how you're progressing. Okay. All right. So we left off talking about performance obligations, and this is we talked earlier about single obligations where I sell you a washing machine and you pay me $300 or whatever it is, and boom, the transaction's done. Even if I have an obligation to pay you in 30 days or whatever, still the transaction is done. The revenue is recorded on the part of the seller, and whether they receive cash up front at the time of the transaction or have credit or receivable, nonetheless, the two sides of the transaction balance, it's either cash debit or account receivable debit and credit to revenue. And that's pretty straightforward, okay? But the problem is, particularly when it comes to business-to-business transactions, where we don't always know, it's not always the case where there's one transaction. And beyond the fact that we don't always know what the dollar figures are, and we're going to get to that. Sometimes there are multiple things going on. And certainly, I think your text used the example of wireless service where you pay up front for a phone and you have an ongoing monthly obligation, and the seller then has to sort of divide these up. And what we don't really get into here, but it's something that I think I mentioned last time, was the fact that sometimes there are more than one seller involved. Certainly in the case of a cell phone, you've got some sort of producer, whether it's Apple or Samsung or whomever, and then you've got a provider of service like Verizon or AT&T or whomever. And that's another complicating issue, but not really, because the fact that those individual sellers have to deal with the revenue that they are recognizing as it comes in. In this case, what we want to really talk about is this example of a company, TrueTech, which is sort of a firm that is it's a hypothetical firm. We're going to carry it throughout this particular module. They make a tri-box system. I would imagine it's something like an Xbox. It's a gaming system. And in this case, there's a tri-box module, which I guess is the physical unit, I'm assuming that is, and a 1-year subscription to it. So those are two different transactions. One is the physical box, and the other is the subscription to the platform that allows people to play games on the internet against other people or whomever, right? So they sell individual subscriptions for $60, and then the individual box goes for $240. These are two separate transactions on a standalone basis. The subscription itself is going to be $60, and then the box itself is going to be $240. However, they have packaged these together, and so they've bundled them, in other words. And bundling transactions are very, very common, where a seller will say, look, here's a discount if you purchase both of these. And we see this all around the place, where we see you get a discount on individual items that are part of the same bundle if you do, in fact, bundle them together, okay? And so they're going to knock off, what, $50, because $240 plus 60 is $300. And as a package deal, you're going to get the buyer's going to get these for $250. And the buyer in this case is not individual subscribers, individual people at home, or rather comp stores, which is a retailer, and $250 per system. And so as a result, 1,000 units were delivered on January the 1st. And I know accounting textbooks love to have all these transactions occur on either New Year's Day or New Year's Eve. As perhaps unlikely as that may be, it doesn't matter. It sort of makes the math a little bit easier. And we can deal with transactions that happen on July 12th or whatever. That's not a problem at all. We can just allocate it. But in this case, all right, so it's $250 per system, 1,000 units. And so 250,000 is received, and it's actually received by the seller on January 25th. We're not really worried about the receipt of cash, because we're really more interested in the revenue recognition much more than we are the receipt of cash, because the receipt of cash it's not unimportant, but it's incidental to the transaction. And it's something that we are and if we don't think we're going to receive the cash, then we have a way of dealing with that as well. And it has to do with this issue of probability of payment. But in this case, we're assuming the payment's going to be made, and in fact, it was in this case. So we're going to talk about whether we can divide these two products and call them distinctive products, and we're saying yes, we can. Okay, so can we identify the contract? Yes. And can we identify what the performance obligations are? Yes, we can. And by the way, where are we getting these? Where's this list coming from? Step 1, step 2, step 3, step 4. It's actually in your text where we talk about multiple performance obligations. We'll get into this just a bit toward the tail end of my class session on Thursday. We were just out of time. And there is another class that comes in on Thursday. I'm actually recording this on Saturday, so there's nobody coming in. But this is where we're coming back to identifying the contract. These are the steps, in other words, for the multiple performance obligations, steps 1 through 5. And we'll cover those as we get going here. So that's where these are coming from. Let's go back to where we left off with the transaction at hand. We identify the contract, we identify the performance obligation, and can we separate those products? In other words, are they distinct products? And yes, they are. You can buy one, you can buy the other. It doesn't really make any difference, right? And I know sometimes sellers, put the arm on you and want you to buy both and whatever. And in this case, we're going to say we can do either one. And so the two distinct goods are, again, the module, which is the physical unit, and the subscription. And so there are two different performance obligations. The question is, how do we recognize revenue that with regard to this? Okay, so we identify the contract. The transaction price is going to be $250 times 1,000 units So in other words, it's price times quantity, 250 price times 1,000 quantities, 250,000. That's the revenue that's being recognized here. The question is, how do we allocate that price among the two different goods? Well, what we do is simply is this, right? We are, let's go back to what the objectives here are. The step 4 is allocate the transaction price to each performance obligation. We're going to allocate the total price to the individual goods themselves, the two goods, based upon their percentage contribution to the total price. It's really not all that challenging. I know that maybe the text is not the clearest on this, but nonetheless, the issue is this. The price is $250. The standalone price would be $240. The module, and then 60 of that. So in other words, we're saying that the standalone price is going to be $240 divided by 300, which is going to be 80%. Okay, remember that figure. What we're doing is we're allocating the contribution of the value of one good to the total good. And then obviously that's 80%. This must be 60%, and it is 60 divided by 300, which is the 240 plus 60 from the standalone prices put together pre-discount. And all we're doing is we're simply allocating these percentages to this discounted price of 250. Okay, that's really all that's going on there. So 80% of 250 is 200, and that goes to the per unit contribution to revenue by the system itself, the module, and then the other 50%, the other $50 or 20% for the subscription. That's all we're really doing is we're simply dividing those out. We're allocating it based upon their contribution to the total value. Okay, and why do companies do it? Well, sellers do it because they want to encourage both products to be sold. Sometimes there's the amount of additional cost involved in providing both is really incrementally small, and so there's an incentive to sell these products because the contribution margin is so large that it's a very small variable cost in order to provide the next unit of whatever it is, like the subscription, for instance. It's probably not a big deal to add one more user or 1,000 more users or whatever. It's fairly small. So as a result, they're trying to incentivize buyers in order to purchase both of those. Okay, so that makes sense to do that. So in this case, we have $250,000 recognized as an account receivable, and the $200,000 again, it goes to the box itself. Okay, that's 200 times 1,000. That's price times quantity. 200 price times 1,000 quantity is 200,000. So we're going to recognize that immediately because that's been recognized. It meets all the criteria for recognizing revenue. We've delivered the product's been accepted. There's value being exchanged. We haven't been paid for yet, but that's not relevant. And then there's a deferred revenue liability that's created here, which is a credit balance account of $50,000. That represents the subscription revenue that has not yet been earned. This is all up front. Remember, upfront payments or prepaids are also known as deferrals. And when it comes to deferred revenue, if you're a seller and you've received upfront payment, it's a liability because you have to perform some obligation in the future, that is to provide access to this product. And so as a result, we have deferred revenue as a credit balance over here. And over time, we will adjust that. We'll move it over to revenue, assuming that there's no disruption and change in estimate or anything of that nature. So, and this is what it looks like then. So for a 12-month period, that deferred revenue piece, which was $50,000, every month at the end of the month, we're going to simply debit deferred revenue and then credit sales revenue. We're simply moving that from one account to the other. So this is the process of revenue recognition. At the end of January, 50,000 divided by 12 is 4167. We're just simply going to debit that to bring down that liability and move it over here to revenue and recognize revenue at that time. Okay. Again, the receivable has been out there for some time. Hopefully, we're collecting on the receivable at some point. If not, then that's a whole other treatment that we'll deal with. But that's what's going on. Every month, at the end of 12 months, we will bring the deferred revenue for this particular event down to zero, and we will recognize 50,000 from that in that 12-month period. And so we will have zeroed out that liability because we have met our obligation. And because we've met our obligation, we now have recognized all of the revenue that was there to be earned. Okay? So that's a fairly straightforward deal. Remember, we're taking the revenue that we've earned up front from the sale of the physical boxes, because that transaction is done. But when it comes to delayed or deferred revenue, we have to recognize it over time. Because remember, in accrual accounting, we are only recognizing revenue when it's actually been earned. And that's what's going on in this case. And we'll get to here in a bit instances in which we have difficulties in estimating what these amounts are, but that's not here. This is a relatively straightforward transaction as to what we're doing. There's nothing overly complex about it, other than the fact that we have two different revenue streams. One is immediate, one is deferred, and that's very common. That's very common that we have multiple obligations going on within what is seemingly one transaction, right? Particularly from the buyer's standpoint. Sometimes the buyer, may not really know or care how the revenue is being treated, but certainly if we're a seller, we definitely do need and want to know how we do it. So there's a slide. This is in your slide package. It's also in the text, but sort of a roundup of all these different issues, all of which have been covered, and so you can go over them. But the key thing I want to focus on is just not these four things, which are, I know you can all read that, but it's this idea of recognition of revenue at a single point in time or over a period of time. And this is really important in terms of how we treat revenue, in terms of do we recognize it now or do we recognize it over time. At a single point in time, there's an obligation to pay. There's a legal title of the asset that's been transferred. In this case, we've sold this company 1,000 of these game boxes. They have physical possession of it. They now have the risks and reward of ownership. They've accepted the asset, and so therefore, revenue should be recognized. Okay. Over a point in time, though, the buyer consumes the benefit over a longer period of time, and they're controlling it as it's being created. And a lot of times, I think your text alluded to this a little bit. We tend to think of goods which were consumed and produced at the same time as being services, and I think that's probably true. And although I know that the text makes mention of the fact that it could also involve goods, as physical goods themselves. And that's probably true, but we tend to think of these as being services. That's sort of the definitional distinction between goods and services, is the idea that services really can't be as easily inventoried and put on a shelf, for instance, as goods can. But so services really sort of meet this criteria quite nicely. And also, there's sellers creating an asset that has no alternative use. And so, in other words, we can't turn around and resell it to anybody else once it's been done. So as a result, that transaction is done, and we can record it if all the other criteria are met. So a quick quiz here, concept check, recognizing revenue. Allen and Company wrote a contract that involves two performance obligations. Product A has got a standalone price of $100. Product B is a standalone price of $200. So together they would individually go for $300 unless the bundle, the discounted bundle price were offered, in which case it is for $240. So how much of the transaction price will be allocated to the performance obligation for delivering product A? Well, this is relatively straightforward. 100 plus 200 is 300. And again, this is product A, which is 1/3 of 300. Pretty straightforward. So 30% of the bundled price is what goes into this transaction. So as a result, it's going to be $80. So 80% of 240 is 30%. Okay, and that's fairly straightforward. If you're going to do B, then it would be 160 because that would be the amount allocated to product B. If we were trying to divide these among individual products, we don't know what products these are. It doesn't really matter. We're simply saying this is the allocation. We don't know what time period these are being recognized. It doesn't really matter. All we're trying to do is allocate these prices, and that's all we're doing is simply allocating the percentage price contribution of each good individually to the new bundle discounted price. Okay. All right. Now, one thing that, and a lot of this thing in this chapter, it's a lengthy chapter. I've indicated before. And a lot of this goes back to this particular issue here. We have these 5 steps where we talk about special issues in revenue recognition. Part B of this, it gets a lot into this, and we talk a lot about these issues of special issues in revenue recognition, and they involve things like what are the specific requirements. By the way, it should say chapter 6. I don't know. They probably didn't make that. This is chapter 6. You notice down here. I didn't even notice the typo here, but these steps 1 through 5. I'm not really going to go through these one at a time here. I will refer back to this quite frequently, because we're going to talk about some of these specific issues and what we consider unique situations. And I don't think we're actually going to get all the way through this part B in this particular video. I kind of prefer to pick some of this up, particularly as we begin step 4 on Tuesday in class, and hopefully we'll get started at the right time and whatnot. So number 1, specific requirements. we'll talk about these different elements here, prepayments, warranties, and all that. There's a lot on variable consideration. We'll talk a bit about that, and then we'll come back and we'll talk more about the rest of these next time. There are a number of different things going on here, and we want to sort of make sure that we cover this. And so let's go to step one here, and that is a contract can be explicit or implicit, that is oral or written. Now, I know that probably everyone here is, or most everyone has probably taken business law at this point, and where you've come across the law that says the contracts can be verbal, and a verbal contract is a valid, legally binding contract, and that is true. However, I can tell you that sometimes there are transactions that are complicated, and if it is complicated, if it's for a lot of money, you probably have something in writing, something as documentary evidence of what is going on, because people's memories differ. People sometimes don't remember what happened and whatnot. So I spent lots of my life around lawyers who will say, get it in writing, get it in writing, get it in writing. And a lot of transactions between buyers and sellers are routine transactions, and documentary evidence can be things like purchase orders, invoices, and prior transactions that have existed before. And so as a result, it need not be an overly complicated thing, probably not involving attorneys, but yes, oral contracts are binding, verbal contracts are binding, but they're problematic when they are very complicated and whatnot. So that's it. Now, I'm not an attorney, so I cannot speak with any kind of legal expertise on this. I can just tell you from an experiential standpoint, that's probably something that would be a good idea, particularly if these are one-off transactions. And so let's talk about a contract. If it exists, it has commercial substance, that is just some sort of value, consideration going back and forth. It's been approved by buyer and seller and customer agree. All the rights and obligations are set out by buyer and seller, what the payment terms are. In other words, all the terms really. And it's also probable that the seller will collect the amounts entitled to. Now, this is where we do get into accounting, and this is where GAAP accounting in particular takes a bit of a divergence from IFRS standards. And that is, under the GAAP standards, we want to make sure that we record revenue if we, and I say we as the seller, expect to be paid for it. And we think there's a high likelihood that we'll be paid for it. In fact, if there's not a high likelihood, and hopefully we don't do the transaction if we think there's not a high likelihood, but if we discover after the fact and we have to make some sort of recognition, mark that receivable down or whatever it is for that. Under the international standards, it's basically a preponderance of probability, something over 50%. And that's a lower standard than what we in the GAAP world will look at. But it's probable that the seller will collect. And so that's an important issue in terms of revenue recognition. By the way, your text makes a little bit of a mention, and of course, this is something that as time fades, we're sort of getting out of the era in the early 2000s in which we had lots of different accounting scandals from corporations. Enron, of course, is probably the biggest. And a lot of it revolved around revenue recognition and the fact that sometimes companies were being overly aggressive at recognizing revenue when in fact they had no right to do so. And of course, if you're interested in Enron, there's a whole bunch of material on what Enron did and why they did it and why they were sort of aided and abetted by regulators and certainly by auditors. But the key point is not to dwell on that whole historical artifact, but rather to talk about the fact that it should be probable that the seller will collect for the amount that it is owed. And if not, then it does behoove and does require accounting staff to reduce the amount of the receivable if in fact it turns out that it's not all collectible. And we'll talk about that more in a second. A contract does not exist if any of these obligations are not met. Now, so neither the seller or customer has done anything. Now, this is important because there are many occasions which maybe a seller can cancel a transaction before it's been consummated. Now, sometimes the buyer has done things on their part to incur cost, and so there may be part of the actual agreement. But the seller, it's not an everyday occurrence with every seller that somebody cancels, but they do cancel. And so as a result, if the seller can back out if the buyer can back out before the seller's done anything, then there is no contract. Okay. And both buyer and seller can terminate the contract without penalty. And there may be penalties, but I think the big issue there is the contract does not exist. And I think that's really the big issue there. Okay. All right. So back to our transaction here with Comp Stores, which is a retailer, presumably buying 1,000 of these gaming units on December 20th, 2020, at a price of $250. Assume that Comp Stores can cancel without penalty prior to delivery. Now, remember, this was January the 1st, but the order actually went through on December 20th. The thing is, though, by January the 1st, the seller made delivery and the buyer took delivery, and so that contract is done. So as a result, the question is, when do we recognize revenue? We recognize revenue when the transaction has been complete or substantially complete, and that's a lot of what, and that's this is a pretty straightforward transaction in terms of that physical unit. Later on, and I think certainly we get deeper into this idea of the fact that sometimes performance obligations take quite a long time. And we're talking about things like construction in particular, which is sort of an important thing. And we'll get to issues in which revenue is recognized sort of incrementally over time. But in this case, this is a one and done deal. Irregardless of the second good, the subscriptions, that's an entirely different transaction whatsoever. But we're going to recognize that on January the 1st. Okay, the date that the product was delivered. And again, we're not getting into freight here and all that, and any kind of other issues there. Let's kind of keep it simple, so we're not talking about freight costs. And if we do, that's a fairly simple matter anyway, but we're simply saying, okay, on January the 1st, the products have been delivered, and as a result, revenue is recognized, okay? All right, so when we talk about step 2, again, what are we talking about? We got to flip back here because they're this sort of master list. It talks about these special issues, prepayments, warranties, options for additional goods or services and whatnot. So, and so let's talk about this. Prepayments, these are essentially booked as deferred revenue, okay? And those are not necessarily performance obligations. So in other words, we're a seller, somebody pays me something ahead of time, turns out the transaction does not occur for whatever reason, and there's obviously an obligation to refund it, I would presume, in most cases, but nonetheless, we would still book it as deferred revenue. If they paid it, you debit cash, credit deferred revenue. And if the transaction reverses itself, it's just the opposite if that happens. And so those are not, so it's part of the transaction price. And it obviously, if you prepay it ahead of time, that's a credit against the total invoice, which comes later. But nonetheless, that's a prepayment from the seller's perspective, which is really what we're primarily dealing with. Your revenue is a supply side concept. That's how we would book it. Quality assurance warranties. These are generally part of the standard standard product delivery. Most sellers will stand behind their goods, and if there's an obligation to make good on something, like I sell you something and it's effective, and I've given you a standard warranty of 12 months or whatever, and in 6 months the thing breaks, assuming you haven't been smashing with a sledgehammer, I usually will replace that, the seller, and so therefore it's a contingent liability. We have a way to estimate that, usually based upon past experience, coupled with future expectations. But that's something basic. That's something that's part of the transaction price itself. It usually does not involve something additional. And a right of return is very similar to the issue of quality assurance. And that's if the seller can't deliver what was necessary, what was needed in the first place. And that is maybe the goods that are being sold are expired, or they're stale, or they're not what was originally intended to be received. And so as a result, those are some issues that come up. But those are pretty standard transactions or standard events. What is a little bit less, it's still common. I don't want to say it's more uncommon. It's still common are things like extended warranties. And let's talk a bit about extended warranties and talk about it. So quality assurance warranties are one thing. Extended warranties are another, and these are usually almost always sold separately. I buy a whatever, and it's usually some sort of durable good. I think probably I can't imagine extended warranties applying on too many other goods other than these durables. But when the buyer says, okay, I can buy the warranty separately, or and the warranty basically extends it beyond what is simply the quality assurance warranty. So maybe it's a 4-year agreement where now I paid up front for this warranty, even over time. It doesn't really matter. And I, the buyer, have got a right to return the goods if it breaks down, if it is defective, whatever the case might be. And the only complicating factor here that I will point out, and we don't get into it here, is the fact that sometimes these extended warranties are offered by other companies that actually then have the liability. they receive the payment or some of the payment, at least that's collected, and then they therefore have the obligation to deal with the warranty if it happens. So we're not really going to get into that, but it's not really that any different than if the seller itself maintained a warranty. In other words, a factory extended warranty as opposed to an extended warranty that was traded off to an insurance company or some other third party or whatever. The treatment is going to be the same on the supply side. Okay. And the option is to provide a material right that is something a customer would not get otherwise. And so the seller is obligated to provide it. And we'll talk about these issues here and what they're really all about. So when we talk about this issue of performance obligations, we're back to the TrueTech example here where they have a coupon. And this gets a little bit tricky. And so we want to look at this because this is maybe one of the more counterintuitive pieces of this chapter, where in this case, okay, there's a coupon given to the buyer that gives buyers an opportunity to buy a headset that normally sells for $150, and it now goes for $90. So in other words, $60 off $150 is a 40% discount. Remember that 40% that's going to play a role in terms of revenue recognition and how the seller recognizes revenue. And there are a couple different ways that happens. The coupon's got to be redeemed within 1 year. And TrueTech estimates that 80% of customers will take advantage of it. So how would we account for the sale of 100 boxes sold under this particular promotional arrangement where there's yet again another good that's being bundled here, and it's a separate good itself. And again, you could buy that good itself separately, presumably for $150, but now if you buy the box, you can also buy this at a discount. So how do we deal with this? Well, the discount's 40% off the $150, and so in other words, the dollar discount's going to be $60, $150 minus $90, $60, and so and if we think 80% are going to be redeemed, then $60 times 80% is $48. That's the amount of the coupon itself. That's the amount that we're going to be recognizing times the amount that we're going to be selling, and so let's put both of these together. This is not an unusual or not a too different of a transaction than the original bundling that we talked about, where the standalone price is going to be $240 plus $48, which is $288, right? Okay, if we divide those up, and so $288 is the denominator here in both cases, and so $240, which again, this assumes too that you also got the subscription going on. So you've really got three different goods here, but we're disregarding the subscription service because that's not part of the discount of the coupon. And by the way, the coupon can be exercised or not exercised. We really don't know. If we think it's 80%, the seller, maybe it's not, maybe it's 85, maybe it's 60, who knows? Okay, so in this case, $240, which is standalone price divided by the bundle price, 83%, so which is 5/6 of the original $240, times 100 units is going to be $20,000 that is recognized as revenue just for the box, just for those units that have that particular coupon offering that attaches to it. Maybe it's a new market they're entering, maybe it's a special affinity program where they're bringing in some group or whomever. We don't know. It doesn't really matter. This is the treatment that we'd have for that. And the coupon itself, the value of the coupon is $48, which is 1/6 of the $288. So as a result, $240. 1/6 times $240 is going to be $4,000 over 24,000 in this regard. So as a result, we have 4,000, right? I'm sorry, not 4,000, over 24,000. 4,000 is the amount of the coupon. That's 1/6 times 240 times 100. Sorry about that. It looked like a division sign. It's 20 plus 4 is 24. Now that's the amount that we're going to record for cash because we're assuming we have sold these goods. We're going to recognize the 20,000. That's the value of the boxes themselves. Okay, pretty straightforward. And then we have deferred revenue based upon coupons. Now, if the performance or the actual experience, I guess, changes, then we have a way to deal with this on the deferred revenue side. Again, this is an estimate, and there are a lot of cases in accounting in which estimates are made, and sometimes it's an unsettling thing for people to know that some of the numbers that we see in financial reporting are estimates much more than they are, really hard numbers. In fact, we sort of contradict ourselves a little bit because in introduction to financial accounting, we sort of present that as being historical reporting. This is what happened, right, and whatnot, right? Whereas managerial accounting, we say this is when it's likely to happen and whatnot. So, but here we do have to make estimates based upon our reasonable expectation of what we think is going to happen. And if it turns out that we're wrong, we make those adjustments. But by the way, this is not a contradiction with a lot of other areas of financial accounting where we deal with things like estimates all the time, things like returns and allowances that we estimate, bad debt expense that we estimate, depreciation expense that we estimate, estimated useful lives of goods. I mean, there are all kinds of these estimates that are made. And if it turns out that the estimate is overly optimistic or pessimistic for that matter, adjustments can be made as we get going down the road. Okay. All right. So a quick question here. A scale company offers a promotional coupon, very similar to the case in which we just looked at with the game boxes. The coupon gives the scale customer an opportunity to buy an electric drill that normally sells for $50 for only $30, 40% discount for $20 divided by 50, which is the original price, is going to be a 40% discount. Coupon is going to be redeemed within 1 year. We don't care about that really. So scale company estimates 80% of customers will take advantage of the coupon. What is the standalone selling price of the coupon? Well, that 80% is going to play a role here because it's an estimate as to the amount of usage here. And so if only 80% are used, then we're saying that if we take that discount 40% of 50, which is the $20 times 80%, the value of the coupon itself is going to be $16. And so as a result, that is the amount of deferred revenue that we record. As time goes on and we experience either exercise of coupons or not exercise, then we move some of it over to deferred to actual revenue and not. Now, one of the things about coupons, and I don't mean to get off on too big of a tangent here, but coupons are a little bit tricky in a lot of ways because there's a lot of companies that experience cases in which people don't exercise the coupons they're given, and it's sort of baffling. I know for years, I don't know, it's been a while since I've bought a computer, but I think Dell would give you a $100 coupon if you bought a computer, and their experience, and I just know from learning about this that a lot of people didn't submit their coupons to get their $100 back, and so as a result, it's an issue that is kind of baffling to a lot of people, particularly if it's a selling point up front and it's a value to the buyer. Why don't the buyers exercise it? That's one of those mysteries, and maybe it's not that mysterious. I'm not a marketing person. Maybe if I were, I would have a better explanation for that. But the redemption of coupons is not always what we think it is. And so in this case, we're talking about buyer B2B transactions, which probably are going to be more likely to be exercised. But certainly on a business to consumer transaction, it's a strange thing. The coupons seem to be sort of dying out in a lot of ways, but that sort of remains to be seen what the future of that will be. Anyway, that's a bit of a sidetrack there. Another example: Hooper offers a discount on an extended warranty on its iPhone. And I'm being a little tricky with this. Is not the Apple iPhone, the iPhone, which when the warranty is purchased, and normally the warranty has a price of $300, they're going to offer it for $240, which is a 20% discount, and the company anticipates a 75% chance that a customer will purchase the warranty along with the iPhones. And so there are 1,000 of those units that have that extended warranty discount. Again, you could discount an extended warranty. You could discount anything. In this case, the extended warranty, which is a separate, distinct product, really, and from an accounting standpoint, it's a distinct performance obligation, is standalone. There are 1,000 of those units that are being sold, or that would apply. And so, and we're estimating 75% that the buyers will take advantage of that. So, what's the total standalone price that Hooper would use for the extended warranty for allocating revenue for these 1,000 contracts, right? And again, it could be that particular offer is only extended to a limited group. Maybe it's a new market that we're entering. Maybe it's one particular seller that the manufacturer is trying to get in good graces with. It doesn't really matter, but we're specifying the number of units that we're really talking about. So here's what the math looks like. It's going to be, the answer is going to be 45,000. And the reason why is because that $60 discount, right, from $300 to $240 has a 75% chance of being used. And so as a result, we're taking that $60 discount times the 75%, and it's going to be times 1,000 units, and we're going to end up with $45,000. And that's the value of the coupon. That's the amount of deferred revenue that we would book as a result of that particular offer. Okay? All right, so we'll do a little bit more here. I think we're going to, get through step 3 here, and then step 4 is its own thing. And I don't want to make these videos just ultra long, even though you can stop and start, rewind, and whatever. That's the beauty of these. But I do want to sort of make them a little bit more manageable, and we will cover the rest of most of the rest of chapter 3 here at least, and we're going to talk about this issue of variable consideration. Remember, we're going back to this sort of issue of special issues, and one of those special issues is variable consideration, also rate of return. I don't think we're going to get into the seller's principle, so I guess we probably are not going to get to all of step 3. I think it's rather lengthy, and so but I do want to get to variable consideration with the rate of return. We'll get back to the issue of principal and agent probably in class on Tuesday. Also, time value of money, and this will take us over the halfway point. And when I don't get done on Tuesday in class, I'll just include a supplementary video so you've got some more feedback on that. Okay, so variable consideration. Let's talk about what's going on here. Number one, with variable consideration, we're talking about that portion of the transaction price which is dependent on the outcome of future events. Now, it's often the case, we should say, that values can't always be reasonably determined up front, simply because of the fact that we have variable outcomes. That's really the whole issue here. So if there are variable outcomes, we have variable consideration that we have to account for. And sometimes we just don't know, right? Things like royalties, it's really not known up front. And if you follow, entertainment news, you'll see that sometimes movies do extremely well on a very low budget, and the royalties are just massive in relation to the upfront costs. Other times the upfront costs are huge, and the back end, in other words, what we call the back end, is not quite so much. And so it's difficult to really know what's going on. When you talk about healthcare, I don't think a lot of people need convincing that sometimes the initial costs or the cost of some treatment are really not known. And even if one had a pretty good idea, those could change at any time. And in this case, we're talking about Medicare and Medicaid, you're talking about government reimbursement, and who knows what can happen there. In fact, the government's talking about has cut some of the Medicaid benefits, and I think some of those are deferred for a couple of years, but a year and a half from now or whatever. But nonetheless, you get the idea that these are examples of these. Also things like rebates and all that. So, and the list is long, so without going through all the list of these contingent, variable, contingent, or whatever you want to call it, revenue recognition. There are really two methods by which we estimate it, and these are both important. And we'll talk about some of the sort of a compare and contrast between A, expected value, and B, most likely amount. Expected value is simply based upon the sum of the probabilities of the various outcomes times the amount to be expected based on each outcome. In other words, it's a weighted average of what we expect to happen, and then we sum up all those weighted averages together to give us a dollar figure as to what is expected. We use expected value all over the place, particularly in finance. It's used in economics. It's the idea that we assign a value to some outcome based upon what the probability of that outcome is. And sometimes some probabilities are very, very low, some are very high. And so as a result, that weighting based upon the probability of it occurring is going to add more value to the dollar figure by which that probability is multiplied. And we simply sum up all those probabilities together to get one large estimate. And this is used all over the place particularly in finance and economics, and here also in accounting. And that's one area there. We'll do some examples, at least one example, to show what we mean. And then also the second is the most likely amount, which is much more straightforward. And in terms of which method here, it really depends upon how well we can compute the outcome and the probability. And I think I think accountants are sort of tasked with this principle known as conservatism, which is not a political orientation. It's simply the principle of conservatism is that we do not mislead users by being overly optimistic as to certain outcomes. And so we want to make sure that we don't mislead. And I know that sometimes that principle is a little bit exaggerated at times. I know some textbook authors will say it's one of the more misunderstood concepts in accounting, in financial accounting. But the idea is that we don't want to mislead users by being overly optimistic, and then have to go back and revise later. By the way, that is not a good thing if you're a public company and and that the amount is very, very significant. You've got to change your estimate. The financial community frowns on, to put it mildly, these estimates that are revised downward in terms of the effect on net income. And so I think, given a prudent approach, a lot of companies will take it easy when it comes to these expected values. But the easiest way is the most likely amount, but that may not be the most accurate. And as your textbook talks about, the expected value method is probably going to be more useful when there are multiple outcomes, 3 or 4 different outcomes, or whatever the number is. I mean, we talk a lot about this idea of A can happen or B can happen, but it could be A, B, C, D, E, whatever, and they've all got different likelihoods and different dollar amounts that are associated with them. So in that particular case, it might behoove us to do the first part as opposed to the second part, but we'll do both, and we'll take a look at both of those. Okay, so in this case, let's go back to our example of TrueTech, and so they now they have a different customer here, Pro Sport Gaming, and they're going to add their games. This is the company that provides the content, apparently, and they offer popular games, whatever they are. And so the terms of the contract are on January the 1st, this company, Pro Sport, pays TrueTech, which is the seller in question here, an upfront fee of $300,000 for 6 months of featured access. Okay, that's pretty straightforward. But then there's a bonus that's going to happen. It's a contingency, and we don't know what the likelihood is, and we've got to kind of figure out how to treat this. That they'll pay us, TrueTech, $180,000 if these users access the games for at least 15,000 hours during a 6-month period. Okay, from January the 1st. Okay, so TrueTech estimates there's a 75% chance that it will meet that target and get the bonus. And by the way, this is either they do or they don't, right? And with the expected value, you're going to have some sort of different number here than 180, simply because the fact that there's a 25% chance that it won't happen. It's going to be a binary outcome. They're either going to get it or they're not going to get it. So the question is, how do we recognize this, given that we have 2 different outcomes? Okay. All right. So let's take the first method, which is the expected value, where, okay, so we know we have 300,000 in deferred revenue that is already there, and that's because it's up front. Okay, so it's 300,000, and we haven't delivered the product yet, but we've been paid up front, and we will earn it over time. Okay, over the 12-month period, there's no problem there. But then what about the 180,000? So there's a 75% chance that we'll get it. So in other words, 180 plus 300 is 480. 75% chance that we'll get that. So as a result, 480 times 75% is 360. The 300,000 times the 25,000, which is basically the 300,000, which we know we're going to get, assuming that we are able to deliver over time, right? We're assuming that we will be able to deliver, but this is not the bonus. This is just the net amount without the bonus. We said there's a 25% chance that'll happen. So as a result, we have 75,000, which is 25,000 times 300,000. We have both of those together. Remember, it's the sum of the probabilities, the weighted average. It's going to be $435,000, and that's the amount that we can expect if we are using the expected value method, right? Which is not 580. Which is not 480. It's 435. Okay. On the other hand, what if we do the most likely method, where we say, okay, we're going to defer the revenue, and we're going to simply say over 180 months, right? We're going to have 480,000 over this 12-month period, and some of that's going to be the bonus receivable. I think it's 6 months, actually, isn't it? Yeah, 6 months. So 30,000 a month over 6 months. And so as a result, if we're saying it's the most likely outcome, because we think there's a 3-to-1 chance, right? 75 to 25, let's just go ahead and book it now. We're going to create a deferred revenue. We haven't earned it yet, but we think we're going to get it. So every month that goes by, I'm going to record 30,000 of revenue as a result of that. Okay. Is that overly risky? Well, I think it's up to the settlement. 75% may not be, excuse me, maybe a high enough burden to get over. I don't know. If it's 90%, maybe it's not, right? But anyway, we're assuming that's going to be the case, and so they're going to record 30,000 per month. So if they do receive the bonus, then what happens is simply that bonus receivable that we create, which is 180,000, when it's no longer receivable because it will have been paid at the end of 6 months, in other words, June 30th. And as a result, 180,000 is credited or debited to cash, credited to bonus receivable. Okay, and we've already booked the revenue up front. All we're doing is simply reversing the receivable. Remember, we're recognizing that revenue as we go, and so as a result, That's going to be, this is the T account for the receivable account that we are, we're crediting, we're debiting all the time. At the end of that 6-month period, we're going to credit it to zero that out because it's no longer receivable. It's been received at that period of time. And so that's the way that we recognize that particular bonus if we use this method, okay? And all of this then begs the question then as to what happens if something goes wrong and our estimates are wrong. So, okay, and so this is a good question, and it's one that we have to account for. So if after 3 months we determine that we're never going to get to this point of 15,000, 15,000 hours or whatever. So the most likely outcome is that we will not receive the bonus. And so we've already been booking revenue here up to this amount here, right? Now, some of that is the 50,000 a month of ordinary revenue just from the sale of the product, but the 30,000 part, which is reflected over here, is for that is the bonus receivable. We've been creating a receivable here, and we've also been creating the revenue, 90,000, right? Remember, the 50,000 is the product itself. This is the bonus that's expected. Doesn't look like we're going to get there, and so the company will then say, okay, after 3 months, all right, we're not going to get the receivable, or we're not going to get the bonus, and so we want to credit that receivable to get rid of it, and then also debit the service revenue. In other words, we're simply reversing the part of the transaction, or the transaction to date, I should say. We're going to take it out of revenue because it's not been earned, and we're going to remove the receivable because we're saying it's not going to happen. For whatever reason, we don't know that it's just not going to happen, right? And so that's and it could happen. It could very easily happen. So, which maybe argues more strongly for the expected value case, but that's not in itself infallible because, either, again, it's a binary outcome. It's either going to get received or it's not going to get received. And so the question is, how do we want to treat this from an upfront revenue recognition standpoint? Now, at the end of the day, if you have a fiscal year that ends on December 31st, then it's not going to be an issue. It's going to raise any concerns, I guess, unless, there's been a lot touted about these bonuses that are going to be earned and whatnot. And sometimes there are performance obligations that do involve bonuses, particularly construction contracts where if a contractor can finish by a certain date, there's a bonus to be had. And that does happen. I think that was part of the deal when the Big I was being remodeled about 20 years ago or so, 25 years ago, when there was a performance obligation because it was a big deal to close down the intersection, the interchange of two major interstates. And so it does happen, these idea of bonuses being earned. Okay. All right. So for the remainder of the contract, then, under this scenario where we reverse that 90,000 that we previously recognized, we've debited it out of service revenue. That's a reduction, and we're only going to pick up $50,000 a month for the rest of that period. And so as a result, that's the way we recognize the rest of that revenue. We just simply go on with our business and do not expect to get the bonus. Okay. All right. And so there's an example here of a company that's involved in some contract with variable considerations called Citi. They pay contract will pay them $2,000 a month for 6 months. Okay, as this consulting services, and there's a 60% chance, based upon Citi's estimation, that they'll get an additional $4,000, and that's $4,000 on top of the $2,000 per month, not $4,000 a month, but $4,000 total, and a 40% chance the contract will pay an additional $6,000. So there's a chance that they'll get an additional amount for whatever it's contingent upon. Who knows? It doesn't really matter. In this case, the consideration, they're going to use the most likely amount. Well, the most likely amount, given the odds that are placed on it, and I don't know any other way to put it, but odds, is 60%, because they think it's more likely than the 40% chance that's given to the higher dollar amount. And that may be good. That may be an exercise in conservatism. So 60% chance. So what is the amount that is going to be recorded for the first month of the contract? Well, we know it's going to be 2,000, right? But it's also over a 6-month period where it's 4,000 that's going to be earned. So we're going to take that 4,000 and we're going to add it to the amount. So it's 2,000 a month, and it's 6 months. So that's 12,000 plus the 4,000 is 16,000, right? 2,000 a month times 6 is 12,000 plus the 4,000. Again, we're not taking the estimate. We're not taking 60% of 4,000. We're taking the most likely amount, okay, which does not depend upon a weighted average or estimated value concept. So we're going to add it to the 12,000, 16,000, then divided by 6. This is a per month. $2,667 that we recognize every month for our consulting contract. Okay. And I guess we're assuming that they're going to get some kind of extra amount, and we don't really know what the terms of this are in all, but all we do know is that this is the way we're going to treat it based upon this method of what we refer to as the most likely amount method. Okay. All right. Now let's take a look here at another option. That is, assume city estimates variable consideration as the expected value. What is the amount that city would recognize? Well, let me just kind of do some of the math here, if I'm able, and to kind of show where some of this is going to end up here. And I'm having trouble moving the camera. Okay, well, let's see here. Oh, shoot, I can't move, for whatever reason, I can't move the camera. So, yeah, we have a lot of trouble. Oh, there we go. We have a lot of trouble with this room. I wish we didn't, but we do. So, all right, real quickly, let's just take a look at what is going on. Remember, this is a 6-month contract. So what do we got here? We have 2,000 a month, so 6 months. And I thought I'd break this out here and do this a little bit on the board here. So $2,000 a month times 6 months. And plus the idea is we're going to say there's going to be 4,000 at a probability of 60% plus 4,000 at a probability of 40%. Okay. And that's simply the way this is looking to work itself out here, right? So, okay, so that's actually 6,000, isn't it? Yeah, 6,000 times 40%, 6,000 times 40. So 40,000 at 60%, 6,000 at 40%. Okay, so 2,000 is going to be constant. We know that's going to be there, and so 4,000 times 60% is going to be 2,400. 6,000 times 40% is also going to be 2,400. If we add these up, then we get 2,000 plus 4,800. I'm sorry, it's 12,000. Well, I'm sorry, it's 12,000. 2,000 times 6 is 12,000. Okay, plus 4,800 is going to be 16,800. And again, this is per month, so we're going to divide that by 6, and we're going to end up with $2,800 per month. Okay. And remember, I know this is, we kind of got this scrunched in here a little bit. Maybe I can sort of shrink it up a little bit. So 4,000 at the 60% level plus the, and again, we can sort of bracket that in the 6,000 at the 40% level. And so this is how these are the terms. 2,000 times 6 is going to be 12,000 plus 2,400 plus 2,400. Altogether is going to be 16,800 divided by the 6-month period is going to give us the amount of revenue that we're going to recognize per month of 2,800 based upon this methodology. And I thought I would work it out a little bit on the board here because I think it's a little bit easier to see, a little bit easier to visualize by doing it that way. And when we do that, I think it helps to sort of make it more understandable as to what's happening. Good. All right. So that's an example of the expected value method based upon this particular scenario. And we'll do a little bit more here, and I think we'll sort of, I don't think we're going to get all the way through chapter 3. I'm sorry, through step 3, because I think it's going to be a little bit much for one video. I just think it's better to sort of break these up into a little bit more bite-sized pieces here. And let's talk about, and that's simply, that's the solution there, but I sort of worked it out more on the board. And let's talk about some other issues with regard to variable consideration in this particular step. And it really has to do with something that I alluded to earlier, and it has to do with this issue of probability and the probability of receipt. And it's a big issue here. And that is that the sellers are going to include an estimate of any kind of variable consideration, whether it's a bonus, whether it's performance premium, whatever it is, rebate, whatever. If it's probable that there's a significant revenue reversal will not occur, okay? And so how do we know? Well, what are the things that would cause a reversal? That would, like in the example, we're 3 months down the road in the game box seller said, hey, we're not going to get this. And so we're not going to get the bonus. And so what are some indicators? Well, bad evidence upon which to base an estimate. That is, we just don't really know. And so maybe we shouldn't estimate anything whatsoever. Almost like we're treating it more on a cash basis than on an accrual basis, particularly if we really don't know or think that there's the odds are remote that it's going to be collected. Remember, it's probable that we have to, only if it's probable that we earn the revenue, okay? There are sometimes factors outside the seller's control, things like weather that we really can't control, things outside influences, and the number of these things that can happen just go on and on and on. And sometimes there are things which impede the ability to perform. And so as a result, and the things that we can't control, things like weather, things like political events, in other countries, who knows? But one big one here is the history of where things have been in the past. And I think that a lot of times experience informs these decisions about the probability of outcomes. How do we know sometimes what we could expect? It's because in the past we've experienced these particular events, so we kind of have a good sense of what's happening. Okay, and if we don't have a history, then obviously that's going to be a missing piece of the equation that really can't be factored in. So we don't really get into conservatives as much in this class, in this text as what used to be in the past, but I think the idea is to not mislead. And so if there's a history of it, then we can support that history. And by the way, we use a history a lot for all kinds of estimates, particularly things like bad debt expense. I mean, we really have no idea precisely what bad debt expense is going to be, but we have a pretty good idea based upon the fact that our experience shows this is what we can expect to see happen. Also, there are a broad range of outcomes that can occur. How do we really know, what's going to happen? Because all kinds of things could happen. So it adds to the uncertainty, and those are some things which, again, as the slide package is talking about, these are constraints on our ability to do it. So which of the following is not an indicator that there's a constraint on applying and recognizing variable revenue in this case? Well, it's going to be C, a short delay, because it's a long delay is a much more a bigger indicator that the constraint applies. Long time periods that are involved, and I think it's a truism everywhere in the financial world that the longer things take to happen, more things can happen and go wrong, or even be much better than what we thought could happen. It's the outcomes get immeasurably larger as time goes on. That's simply a truism that I think is easy to recognize. And so in this case, if TrueTech cannot conclude that it's probable that a revenue reversal will not occur in the future, then what they're going to do is they will then take the revenue and they will simply book it and say, okay, we're the upfront revenue, and again, this goes to the idea of we're not booking any kind of a bonus because we really don't know. Why? Because we're constrained associated with the fact because we just don't know what's going to happen. Now, it could be a pleasant surprise at the end of 6 months where, hey, we get the bonus, right? But we really don't know. So as a result, on a monthly basis, we're going to only book that amount that we are reasonably sure based upon the reasonable probability of collection, okay? Now, after 3 months have gone, this is another scenario where we say, okay, now we conclude now we can make an accurate bonus based upon the prior judgment that we could not make the decision. Remember, we go back one here and we say we couldn't make the determination, so we didn't. We just booked the 50,000, per month over the 6 month period. But now we're saying, okay, there's a pretty good likelihood that we can, a 75% likelihood, and we're going to, obviously looks like we're going to be basing upon the most likely method. And so as a result, we're going to pick up those 3 months that we did not book it because this is 3 months down the road, April 1st. And so we're going to book that into revenue, and we're going to have the service revenue, which is going to include the 50,000 that we have deferred for that period of time. That's based upon those monthly figures. And then the bonus receivable, which is going to be 30,000. So as a result, we book that amount into revenue. So what we're simply bringing things current based upon the fact that we have now recognized that there is something that's happening, and we are now going to recognize that. So because we think that our estimates are correct or accurate. Okay. And then one of the final things I think, and I think we'll sort of stop here, is because it's going to take a bit longer to get into some of the issues concerning principal versus agent and whatnot. And that is the issue of right of return. This is not anything that's really complicated. And it's really based upon topics that we covered in 2110 or the first principles course. And that is, if a customer can return a good because they're unsatisfied or whatever, which is the most common case, frankly, then we have not satisfied the performance obligation. So it's a contra revenue, right? And this is the example of the matching principle where we're trying to say, all right, we have sales. And remember, on an income statement, we have sales, then we have particularly there's physical goods involved, we have returns and allowances and sometimes sales discounts. If you don't offer discounts, then that's not one of the contra revenue, but certainly returns and allowances. Allowances are simply where we, knock off a certain amount of price, and so we take a sales price reduction. But a return is where the buyer says, okay, this is whatever the problem is, we're returning it to you, and so we record it as a contra revenue, and it's an informational item. Rather than reducing revenue, we simply keep the original gross revenue and we book it as a return. And it's an informational item in the sense that it communicates how much of sales were not actually earned because they were returned. And it really communicates it's a performance issue, how poorly or how well the seller performed in this case. And I indicated here, and again, the green type is my own. It's a matching principle because we want to match these returns with in the period in which the sales actually happen. Now, here's the thing. Yes, it's one thing for us to do this in sort of a real-time basis, where we only record these as they're being returned. But from an accrual standpoint, from the matching standpoint, we're going to do an estimate, particularly as we approach the end of an accounting period. We want to make sure that we sort of match these returns up with the revenue that corresponded time-wise with. So if we sold 1,000 try boxes to comp stores for $240 each, we have $240 in sales revenue. And we're going to estimate 5% are going to be returned for whatever reason. Maybe that's a high percentage, I don't know. But 5% of the 240 is going to be 12,000. Again, it's contra revenue, so net sales revenue is adjusted for that particular estimated amount of returns. Okay. And I think it's likely that there are going to be returns that happen. There are goods that are defective, or there's something wrong, or there's the order is not messed up or something. So it's a pretty good bet that that's going to happen. So one quick final thing, and then we'll take we'll sort of end this today. We'll say, in this example, a Braun Computer Company sells computers with an unconditional right to return the computer if the customer is not satisfied. And I underline here a long history. And again, that's sort of indicative of the fact that we can make an estimate. This is sort of a giveaway. There's a long history, so that sort of suggests it's more implicit here, but I think we can kind of follow the line of reasoning. They have a long history of providing precise estimates of the amount of returns associated with every sale. And so, what happens? Do we ignore the potential returns, or do we reduce them by the expected returns, or do we do it when the customer returns the computer? Well, that would be more like a cash basis situation. Well, we're going to do it as based upon the idea of we're going to estimate returns, and as we book the revenue, we're also going to book the expected returns. Now, maybe nothing comes back ever, in which case that would be a good outcome. But again, if we have a long history, then maybe that's not a realistic assumption, particularly if you want to try to match those returns against revenues. Because, by the way, you might sell a good on December 20th, and then for maybe Christmas shopping season or whatever, and then your year ends on 12/31, then somebody brings it back on January 3rd. Well, if you wait until the customer brings it back, then you're doing a mismatch between revenue earned and the return, and that's not what we want to have happen. Instead, when they do return the computer, we will charge it back to the amount of returns, and that's simply the way that we would handle that, just like we would bad debt. Okay. All right. So I think we'll stop there. When we come back on Tuesday, we will talk more about these issues concerning things like principal or agent. I think that's a good place to stop right here, and we'll talk more about what the differences are between those two legal sorts of involvement by sellers, and we'll get it. Again, this is a fairly dense chapter. There's a lot going on. I know there's a lot. We just can't cover it in the class time we have available, even when we do have things working correctly. But I do want to make sure that I cover it, mostly because of the fact that it's all necessary to understand. And if you do have questions about things individually, feel free to get with me. Email is a good way to reach me. You can also stop by my office if you like. If you're on campus or near campus, feel free to do that. My office hours are on the syllabus itself, but do reach out if you do have questions. Okay? All right. I will see everybody in class on Tuesday.